This is a video on some background on valuation. There will be a subsequent video that will talk specifically about the input values used by the Polaris valuation formula. But this video is primarily just an overview of the general topic of valuation, and then narrows in on out of all the whole topic of what Polaris does. Just to give you a little roadmap of where we're going, we're going to talk briefly about the discounted cash flow model, how analysts typically do discounted cash flows, and then we're going to get into the specific formula used by Polaris. So first off, let's talk about different kinds of valuation methods that are out there. This is a chart provided by Dr. Damodaran out of New York University. Real quickly, just left to right, it's kind of an older way of looking at valuation, is just valuing the assets on the balance sheet of a company. This is more historical. That's Graham Dodd kind of initial approach back in the 50s when there was a lot of more manufacturing going on, and that's still an appropriate method for heavy manufacturing type businesses. Discounted cash flow, there's several, as you can see, different ways you can do discounted cash flow. Polaris primarily does a two-stage free cash flow method of valuation. There's also relative valuation, which a lot of analysts, professional stock analysts, use. Most of us are familiar with relative valuation as it relates to home price, an asset of a home, and how home prices are typically set as relative to how other homes are priced, without really trying to understand why they're priced that way. Just what's the price relative to others. Dr. Damodaran refers to relative valuation more of a pricing exercise than it is actual trying to get an economic value that the company brings. Contingent claim is kind of a more of a quant way of looking at it, coming out of MIT and University of Chicago, places like that, it's based on option theory, and primarily for young firms or firms that are going through a lot of transition, like a distressed firm. So that's a brief overview on the different valuation methods. Where I want to go next is talk about just in general, because I know it's been a while since many people have taken an accounting class, but I'm not going to make this into an accounting discussion, but I just want to briefly remind everybody that a company is here on the left. It's at its core, it exists to create value, which value essentially means do more with less. The more you do with less, the more value you're bringing to the market. And to generate value, a company can be thought of as doing three main activities. They're operating, buying, selling, they're out in the marketplace producing products. It's what we typically think of when we think of what a company does. But there's also investment activities, primarily around fixed assets and things like that, where you purchase things to benefit you into the future in terms of your operating activities. And then you've got to be able to finance those investment activities. And so to finance, you go out into the marketplace and either go and get debt and get cash from that debt, or you go out to shareholders and get cash from those shareholders. Now, going back out to the marketplace, you pay interest on debt, and you pay dividends or stock repurchases back to stockholders in terms of your financing activity. Now, as it relates to the overall company, we're going to get into a thing called cash flow. But I think what I want you to remember is that cash flow comes from operating activities, but it also can come, as it relates to stockholders, can come from debtors. Cash does come from issuing debt, and if you use leverage appropriately, it can benefit stockholders by generating additional cash, because you're able to use that debt at relatively low interest rates, generate higher returns on it, pay back the debt holders a portion of that return, and then pay the additional return back to your stockholders. Same thing for stockholders, or cash from stockholders. Most of us think of it as initial stock offering. Cash comes in from that initial stock offering, but there could be subsequent stock offerings, and then you get into this kind of a wealth transfer between existing shareholders and new shareholders, and cash can come back in from new shareholders that actually benefit existing shareholders because of the market price at any given time may be over or under what the intrinsic value is. So there is some wealth transfer when you go back out into the marketplace and float more equity or buy back equity. Anytime you're going to the marketplace, there's always chances for intrinsic value and market price not to equal at the time you go into the marketplace. All right, let's go on to a quick view of an income statement, then we'll get into discounted cash flow. At the top of an income statement is revenue, at the bottom is net income, and in between that represents really operating activities, primarily cost of goods sold. How many things did you sell? What was the material costs, labor costs that went into that? And that's the main component of operating costs. Now there are what accounting calls period costs, to say that they can't really clearly associate it with individual products. So they just say that when you incur these expenses, they're written off in the current period. So these things like selling, general administration, things like that, R&D, which is one that particularly for young startup companies can really change when you just look at net income, it can really skew net income because a lot of this R&D is done for future benefit, for future products, yet it's being written off in the current period. And then you get into the financing aspect of a company where if you are paying debt, you have to pay off debt. You could even have some small investment that you've made, maybe as an insurance policy, you've held back some cash as opposed to paying the dividends to the stockholders or reinvesting in the company, and then that would be represented by that line item. Then you pay taxes, then eventually get the net income, and then you pay some form of a possible dividend back to your stockholders, or you purchase shares back. Now, I want to get into what cash flow is. Cash flow is not net income. It would be tempting to look at the dividend relative to net income and say, okay, dividend divided by net income is the payout to the stockholders. And what's left, it may be tempting to say that's the plowback or the reinvestment back into the company. But that's really the wrong way to look at it, because when a company reports net income, it has really three choices to what to do with it. Either reinvest it back into the company, which accounting, by the way, refers to as retention. How much of that net income do you retain? Finance people like to think of that as reinvestment, and as opposed to payout, which what accounting uses, is more of a distribution that goes back to the stockholders, is how finance people think about it. So net income minus dividend is not really strictly the reinvestment. There's actually another place that the money can go, and I've referred to it briefly up here when I pointed out that companies can choose to not invest in themselves, but just park the money until they need it, maybe for a future project that's not quite ready to go, but they want to have the money set aside, ready to go. Or it could be something like a lawsuit or something that's pending, and they just want to have contingent money on the books in case they need to use it for that. So it's money that's not reinvested in projects, but it's not given out in terms of dividends or stock pay back to the stockholders either. It's a third category of money, and that's really what cash flow, how it mainly differs from just net income after dividends, is that just net income, is that there's three buckets. You either give some back to the stockholders, you reinvest in projects, or you retain some for future opportunities that haven't been identified yet. And so cash flow is more of that potential dividend as opposed to the actual dividend, which is a discretionary decision by management as to how much to pay out in dividends. It's how much additional cash could you have paid out that you chose to just keep hold of for now and use for future projects. Add that back in, and that becomes the total cash flow that or potential dividend that you want to keep want to account for when you do cash flow type discounted cash flow. Well, let's go back to the Word document. You can see here that again, we're talking about present value of these near-term cash flows. That's again what dividends were paid plus what was kept on the books for any future projects or things or lawsuits that may come up. And then there's a terminal value. So let's go look at how analysts typically do this kind of exercise. Is they do go down line for line, pretty much like an income statement. They say, well, what is the annual revenue year by year? What's the operating expenses, which is represented by the operating margin? You get operating income. Then you get into taxes, and you end up with in this example, free cash flow before investments of debt and that kind of thing. Along with the calculation, there is this thing called reinvestment. So it's the net income. How much of that, or this cash flow, sorry, how much of that are you going to reinvest in specific projects? Again, if you don't have specific projects in mind, you're just holding back on the money. That's not really reinvestment. That's this third pool of money. So there's reinvestment, dividends back to stockholders, and then this parking money for future needs. But when you do this kind of cash flow analysis, you're looking for what was actually reinvested back in the company. Then you end up with the difference between the operating income and the reinvestment as the free cash flow that was available. And then you but it's free cash flow to the firm, so it's both debt holders and stockholders. And then what you do is you see here that for Uber, negative amount in the first year, and then very little in the second year, and then more positive cash flows projected out through year 10. But to keep going to year 11, year 12, it gets to a point where you're so far out into the future that any specific forecast gets to be somewhat meaningless. So most analysts will pick so many years out. In this case, it was 10 years out. Polaris uses 5 years out, but you stop after, I'll call these explicit cash flows. You stop trying to forecast explicit cash flows after a certain time frame. And then you do a thing called terminal value calculation, where you assume some steady state has been arrived at in terms of what you can count on for more growth, more kind of regular growth and things, where you can just discount all that future activity back into a single number. And then you end up with free cash flow to the firm, and then there's a way to take that value and end up with free cash flow to just the equity holders, and then divide by the number of shares outstanding, and you get what the expected intrinsic value is per share. All right, so that's a lot of background. Let's talk now about the next step you can do beyond the explicit cash flow is you can use some kind of a formula, not only for the terminal value, but you can also estimate if you felt like the company was doing regular enough growing of cash flows, even in the first couple of years. You could even do that first phase of estimating a starting cash flow, some growth to that cash flow, discount it back, a little bit of growth year over year. And then the second part of it again is you stabilize some cash flow, constant growth. And I won't go through the details of that. Polaris uses a simplification of that previous formula, in that the first part of it just says what's the annual dividend this year times the number of years that I think, actually this should be Y, just how many every years. And again, that analyst used 10 years, but you can Polaris uses 5 years, but some number of years, the number of dividends. Now, really, compared to this up here, we're not discounting back, we're not growing the dividends year over year, but those two mathematical operations of growing the dividends and discounting back, they don't exactly offset each other, but they offset each other enough that a valid simplification is just to take the current dividend times the number of years that you feel like represents kind of a higher growth or some kind of unique period in the life of the company, and you just account for cash flows just being that dividend for that many years. And then you get to the terminal value, which you feel like the company will stabilize. And this formula is really quite easy to understand. You just take the current sales and you assume some growth rate over the first Y years, get to what you feel like will be your future sales. You multiply it by a profit margin that you think will be in existence so Y years out, and then divide that by the future shares, and you get earnings per share. Then you just take earnings per share by times a mean reverted price earnings ratio that you think will be around in that many years out. And then if you want to calculate, and that'll give you a future price that you're expecting. And then if you want to know what the valuation today would be of that kind of a future for a company, you could discount back that terminal value to today using a cost of capital. Now I want to talk about that discounting back. Is that what I just briefly went through helps you identify this red dot for essentially, which is so many years out what you think the price is going to be. And then if you want to discount it back in time, you discount it back to get some value here today. But for Polaris, that discounting back and it does show on the Polaris side about a present day valuation based on this anticipated price in the future. But what's most important for Polaris is this line that connects the projected future price with the current price, and that's the trend line that's expected by Polaris over the next 5 years for the price to eventually arrive at the projected price in 5 years. And then what you want to do as an investor is modify. The market obviously will move up and down around this, but you want to make sure that it's trending overall and to eventually arrive at the 5-year mark. So discounting back, yeah, it's interesting. Shows you a value today compared to the price today. But what's more important as far as Polaris is concerned is where do you think you're going, and then constantly monitoring where you are on the path as you head towards hopefully your eventual future price. So the next video, what we'll talk about is getting into the specific inputs used by the Polaris valuation formula, which now that you see what it is, realize that dividend, current sales are lookup values. They're not values that you actually enter. And the same thing for current number of shares. So when you go to calculate future shares, it's based off the current shares. So those three values are looked up, and then the remaining input values are either defaulted by a default calculation by Polaris, or use the user enter them in. And we'll pick that up in the next video. Thanks.